Hello and welcome to this online lecture where I'm going to be looking at the key business tax issues coming out of the Finance Act of 2014. My name is Chris Jones. Firstly, let's take a look at the annual investment allowance increase, which has been increased to £500,000 effective from the 1st of April of 2014 if you are a company, or the 6th of April if you're a partnership or an individual. However, the bad news is that unless something changes in the meantime, and something is likely to change in the meantime, perhaps the government themselves will change in the meantime, the limit will revert back to the £25,000 amount effective from the 1st of January 2016. Now, before we entered into this dizzy heights of a £500,000 annual investment allowance, whereby essentially you're able to write off the entire cost of your capital additions, but not cars, sadly, we actually were sitting on a limit of £250,000, 250,000. And of course then it suddenly dropped like a stone to £25,000. As a result of these limits going up and down, we end up with another load of transitional rules. And we need to look at those because in time, when we actually see it drop like a stone, we will need to be advising our clients very closely unless things change. So let's have a look at the rules that apply on the opening transitional rules, and full details of these examples that I'm outlining to you on the screen here are given in the supporting notes. So the way that things will work here is that the time apportion will restrict the start period to £250,000. I'll explain that as we look at the example. So let's take a classic year end of December. So we take the year end of the 31st of December 2014. What is going to be the maximum amount that you'll be able to claim as AIA? Well, it's going to be 3 months worth at £250,000, which is £62,500, although in reality these calculations are of course done to the nearest day rather than month, but I'm just simplifying it here for you. And also then 9/12 of £500,000 as it goes up from the 1st of April, which is £375,000. So the total amount that you could claim in that period is £437,500. But the important thing is when you spent the money. When do you need to have spent that money? So if you spent any amount in the first 3 months of that year, i.e. from the 1st of January to the end of March, what you'd look at there, you think, well, the maximum I could relieve is £62,500. That's actually wrong. The maximum amount you could get is the full 250, according to the transitional rules. So therefore, if you've spent up to £250,000 by the end of March, you can get that, no problem. And then anything else you've spent after that period, you can claim that up to a level of £437,500. So that's actually pretty good rules coming in. But let's look at the sting in the tail at the other end, where we drop the allowance down to just £25,000, the closing transitional rules. At the end period, unfortunately, the amount that you can claim in that last part of the accounting period will be the new limit apportioned to the £25,000. So let's have a look at the example here, where we have the year end of the 30th of June 2016, where the first 6 months of that period, you've got £500,000 worth of AIA, which is £250,000, and the other half of the year is only at £25,000, which is £12,500. Total AIA for that year is £262,500. But what about the timing of expenditure? Well, when you're looking at how you close this out, the maximum allowance you're going to get for any expenditure incurred from the 1st of January to the 30th of June will only be £12,500. And bearing in mind, often for cash flow purposes, many businesses spend their money on capex towards the end rather than the beginning of the period. If you're not careful, you could lose out on a very large amount of allowance. So it's very, very important that you actually get, if you need to spend it and you want the relief, you actually need to spend £250,000 and commit to that by the end of December. And by commit, what we are looking for, that the company or the trader enters into a binding contract to acquire that plant. As long as they've signed a contract agreeing a firm order where it binds them into spending that money, provided they don't have a credit period of more than 4 months, then they'll be able to lock that in at the end of that period. So as long as they enter into the contract and actually make the payment by the end of April the following year, they would be okay. Let's turn now to some changes to the research and development rules for small and medium-sized enterprises, because this is again good news. The Chancellor is encouraging business to do more research. So essentially what we're looking at is, in order to encourage that, the Chancellor has increased the payable tax credit from April 2014 to 14.5% of the amount of your claim surrender. And essentially what that means is, of course, you spend your money on R&D, you get your additional enhanced relief of that R&D, and then you can sell that back, because of course if all your enhanced R&D is doing is augmenting or creating a loss, it's not much use to you unless by carry forward. So what you do is you say, well, I'm not going to carry forward that loss anymore, I'll sell it back to Treasury, cancel the loss out, and receive hard cash from the Treasury. And that equates to 33% of your original spend. When you, of course, enhance the amount that you get and get 14.5% of the enhanced amount back, that works out to be a third of what you've spent. Previously, that was just 25%. So that's really generous relief. And the restriction that used to apply is no longer there. What used to apply is that HMRC is completely against their psyche to hand taxpayers any money back. They like to collect it off people. That's what they do. So therefore, in the past, we used to have this rule that you could only get a repayable credit up to the amount of the PAYE tax and national insurance amounts that you paid in the tax months ending in that particular accounting period. So they don't only give you money back that you've already given them in PAYE. Well, that restriction's gone. So therefore, you're not going to be capped on that amount either. Now, the point to bear in mind with research and development, this is a very key point here, is people assume that R&D is people walking around in white lab coats and stethoscopes looking a bit geeky with plaster holding their glasses together. Now, that's sort of stereotypical of what a business does when it's doing research. And the other thing is people think, well, in order to sort of get this relief, whatever I'm researching into, it's got to be successful. So let's say that I've got this brilliant idea that the whole world is going mobile. And the way the world is going mobile is that every device gets smaller and smaller and smaller. So, do everything you can on a computer, on your iPhone these days, and it's a camera, and it's your email, and it's all sorts of games, and it's the internet. But even that's too big. An iPhone is a big clunky thing, so I'm going to make it even better. I'm actually going to create some sort of eye lens. Where I have a contact lens, I shove it in my eye, and I've got Facebook in my eye all the time, something in my ear, so I want to talk to my mates, and a microphone in my mouth. And I actually have an operation to install this stuff in my body. So I'm actually mobile myself. So I don't need to have any equipment with me. I can take the whole internet, the whole world with me in one simple contact lens. Wouldn't that be awesome? I'm clueless about how you develop it, but I tell you what, I'm going to find a few geeks who might know what they're doing with something like this, and I'm going to spend staff costs, etc. on doing it. But it turns out that actually it's just too clever for these geeks. It just can't be done. And I wasted my money. But at the end of the day, I'm still getting my relief, because as long as I prove that I've done the research to bring forward push forward the frontiers of human knowledge, trying to solve an unknown scientific reality, as long as I prove that I've done the research, it doesn't have to have been successful. And that's where people fail. So talk to your clients. Have they started to do things that are revolutionary, but they failed and they've not told you, because people don't talk about their failures, they talk about their successes. So try and get your clients to talk about their failures, because they can get some money back on those, and that might sort of sweeten the pill a bit. Turning now to the creative sector, there's been a few changes to the film schemes, whereby we have the rules that apply to the film scheme were that you had to have 25% of the money spent on the film had to be relating to expenditure incurred in the UK. That's now reduced to just 10%. Because a lot of the British films that we are making now, of course, are based on things that happen in other countries, and hard to film those in the UK. The payable tax credit has now gone up to 25% on up to the £20 million for the expenditure, and drops to 20% for expenditure thereafter. So much more generous, and of course that will actually encourage more of these arrangements. Slight amendments being made to the video games relief to match EU approval. You'll see details of those in your supporting notes, and small changes to the television relief as well. And just bear in mind that certain types of television programme or films are excluded. Those you can find separately on the internet, should you be interested. Turning now to theatrical production relief, very similar to the film tax relief, production company qualifies for an additional 100% deduction Up to 80% of the core spend must be in the EEA, and therefore they can actually deduct, arriving at their taxable profit on that theatrical production, more than they actually spent. And in addition, if that creates or augments the loss, they can sell that back and get a payable credit of 25% of the amount that you surrender if it's a touring production, or 20% if it's a non-touring production. Enterprise zones, some changes there. 100% plant and machinery allowances available on top of your normal £500,000 worth of AIA, but with significant restriction, only to enterprise zones actually already out there. And this must be genuine expansion of your business. You're not actually replacing plant you've already got. If you're replacing plant you've already got, you use your normal £500,000 AIA. If you're expanding and investing in brand new plant, you've got this 100% deduction on top of your £500,000. Okay, so just bear that particular point in mind, and it's only in designated areas. Further details are available, of course, on your supporting notes and online. Some changes to BPRA, or the Business Premises Renovation Allowance, some changes to tighten up the scheme. One of them actually is a good change in the fact that if you breached any of the rules, i.e. you don't own the property for a certain period after renovation, there used to be a clawback of the relief if you sold the property within 7 years. That's just now reduced to 5. So therefore we're not looking at sort of less of a cut and run now. So therefore, it might attract more people to renovate those premises, knowing they haven't got to stick on with them for 7 years. That seems like an age. 5 years, well, most businesses do their planning on a 5-year sort of rolling forecast. So that might actually be quite a useful change there. There's abuse of the relief developing. And bear in mind, of course, that these rules only apply to designated areas from 2014 through to 2020 designation. Let's just look at BPRA. More details in your supporting notes, but in order to claim the relief, you must meet both Condition A and Condition B. Condition A is around the conversion, renovation or incidental repairs of business premises which are currently uninhabited, and you're actually then turning them back into sort of usable premises. And Condition B is the nature of the expenditure. The expenditure must be on, obviously, works to the building, architectural, surveying, planning, statutory fees, except other expenditure up to 5% of the building works, architects and surveyors. So therefore you'll see that it's what you spend money on, and you must be to spend money on certain types of conversion of those premises. Certain things that are excluded are things like fixtures, and there's a long list of those fixtures in your supporting notes, but things like integral features or parts of integral features, window cleaning or installations, fitted cupboards and blinds would all be out of this particular relief. So that, for example, when we moved into our new offices, we actually had a big fit-out cost. Some of that was actually sort of fitting new desks and lockers for our staff. Those obviously would not be included. Things that also are out are things like cabling for telephone or your computer networks, which of course you will install in most buildings in any case. Your kitchen facilities, public address systems, intruder alarms, they're all excluded. We are talking about here literally just getting the sort of the internal framework of the building ready for you then to do the fit-out thereafter. Excluded expenditure also includes any cost which exceeds the market value of the property once done. In other words, you'd hope that would be the case anyway. You want to spend more money on the building than it's actually worth at the end of it. The building must be occupied in the 12 months prior to the expenditure being incurred, and delays of 36 months you can actually have to unwind the original claim. If there is a grant aid, then up to 3 years post completion, then of course that's also excluded, because of course you can't claim tax relief on something you're getting a grant for, quite obviously. Well, I hope that's been a useful run through of the key business tax issues in the Finance Act of 2014. My name is Chris Jones, Director of Tax Markets at Tolley.